Are we heading into economic turmoil or finding hidden opportunities? Our in depth analysis covers the Fed's unpredictable rate decisions, rising inflation fears, and potential market shocks. Hear from experts predicting prolonged economic uncertainty, equity market corrections, and the fate of your investments in gold, Bitcoin, and real estate. Stay informed and anticipate what lies ahead in this volatile financial landscape. Today on Financial News in Review, we will summarize the following videos. From Adam Taggart, Thoughtful Money, we have the Fed walks back its interest rate cut guidance yet again. Axel Merk. From Blockworks Macro, we have Growth Scare Hits, the U.S. Economy, Knapp on Fed's Quadrilemma, Lehman, and Job Market. From Blockworks Macro, we have Stocks will continue to crush bonds in 2024, Joseph Wang. From Blockworks Macro, we have Get Used to 4% inflation and 4 to 5% interest rates, says Jim Bianco. From Kitco News, we have When Fed Pivots Markets to See Dramatic Drop, Here's Why, and What's Next for Gold, Bitcoin, Soloway. From Kitco News, we have Fed Holds and Signals Just One Cut in 2024 after ECB and BOE ease. Powell explains why U.S. isn't ready. From David Lynn, we have Inescapable Debt Trap. Fed going right back to 0%, Brien, Lundin. From David Lynn, we have Fed keeps rates unchanged. Hard landing approaches, Lobo, Tiggre. From Oxbow Advisors, we have Ted Oakley, Bloomberg Business, June 13th, 2024. From the Julia LaRoche Show, we have We Need a Big Drop in Interest Rates to Fix the Commercial Real Estate Problem, Jonathan Treussard. Certainly. Based on the information provided, here's a structured summary of the interview between Adam Taggart and Axel Merk. Interview summary. Title: Does the latest Fed guidance actually change anything? Axel Merk YouTube channel, Thoughtful Money. Guest name: Axel Merk. Main topic: Analysis of the latest Federal Reserve guidance and its implications on the economy. Core thesis: Axel Merk provides a comprehensive analysis of the latest guidance from the Federal Reserve, exploring whether it signifies any significant changes to the economic outlook. Central message: Axel Merk argues that while the latest guidance from the Federal Reserve appears to indicate changes, the fundamental economic landscape remains largely unchanged. This is supported by his thoughtful commentary and analysis of economic data and market reactions. Key points discussed by Axel Merk. 1. First key point. Axel Merk elaborates on the Federal Reserve's recent policy adjustments. He discusses how these changes are perceived versus their actual impact on the economy, using specific examples from recent market data to illustrate his argument. 2. Second key point. He also discusses the historical context of Federal Reserve decisions, highlighting significant quotes from past Fed officials and referencing empirical data to strengthen his case. This comparison underscores the continuity in the Fed's approach, despite apparent short-term shifts. 3. Third key point. Additionally, Axel Merk covers the broader economic ramifications of Fed guidance, such as potential impacts on inflation, employment, and investment. He provides additional examples and context to give a well-rounded view of these complex dynamics. Key predictions by Axel Merk. 1. Prediction 1. Axel Merk predicts that the Federal Reserve's policies will lead to prolonged periods of economic uncertainty as markets continue to react to mixed signals from the Fed. This has implications for investor strategy and risk management. 2. Prediction 2. He also forecasts that inflation will remain a pressing issue, despite the Fed's efforts to control it. This suggests that consumers and businesses may need to brace for continued price volatility. Conclusion. In conclusion, Axel Merk summarizes his insights by urging viewers to remain cautious and critically evaluate Federal Reserve announcements. He emphasizes the importance of understanding the broader economic context rather than getting caught up in short-term policy changes. Axel Merk encourages viewers to adopt a long-term perspective and to stay informed about ongoing economic developments. Key takeaway. The main takeaway from Axel Merk's analysis is the need for vigilance and a measured approach to interpreting Federal Reserve signals as the underlying economic challenges persist despite new guidance. This summary captures the essential points and structure of the interview, providing a clear and concise overview of Axel Merk's discussion on the implications of the latest Federal Reserve guidance. Title: Growth Scare Hits the U.S. Economy, Knapp on Fed's Quadrilemma, Lehman, and Job Market. hosted by Blockworks Macro. Guest Barry Knapp, founder and CEO of Ironside Macro. Main topic: examination of the current state of the U.S. economy, focusing on the potential growth scare, the Federal Reserve's policies, historical perspectives on financial crises, and insights into labor market trends. Thesis statement: Barry Knapp offers a multifaceted analysis of the current economic environment, emphasizing the interconnectedness of fiscal policy, monetary policy, and structural economic factors in shaping market dynamics. Central message: Barry Knapp argues that while fiscal policy remains highly accommodative, the Federal Reserve's restrictive rate policy, combined with structural issues in the labor market, could lead to a significant economic slowdown, necessitating a delicate balance between growth and stability. Key points discussed by Barry Knapp. 1. Growth scare in the market. Details and evidence. Barry describes the recent changes in market perceptions with softer GDP growth figures and declining job openings. He emphasizes the potential for a growth scare that could disrupt the current equity and bond market rallies. Specific examples: weaker than expected GDP print and job openings data. 2. Fed's Quadrilemma. Details and evidence. Barry explains the concept of the Fed's Quadrilemma, where reconciling different policy tools and objectives, fiscal policy, unconventional policy, rate policy, and labor market conditions, poses substantial challenges. Significant quote: to get the Fed to cut to a level that would painlessly disinvert the yield curve, you need the unemployment rate to go above 4 and wage growth to fall below 4. Small business employment weakness. Details and evidence. Barry highlights the ongoing struggle of small businesses, exacerbated by high borrowing costs and limited credit availability, which is a critical component of overall employment. Additional context: discussions on ADP small business employment numbers, NFIB surveys, and QCEW data pointing towards significant employment revisions. 4. Financial conditions and Federal Reserve policies. Details and evidence. Barry provides a comprehensive breakdown of the Federal Reserve's policy missteps, arguing that an alternative approach, more aggressive balance sheet unwind with fewer rate hikes, could have mitigated the negative effects on small banks and businesses. Examples of policy impacts: deep yield curve inversion and its existential threat to small banks. Key predictions by Barry Knapp. 1. Equity market reaction. Details. Barry predicts that the equity market is likely to experience a correction before any significant Fed rate cuts, due to the need for decisive evidence of economic slowdown. 2. Federal Reserve's future actions. Details. Barry envisions potential Fed rate cuts by the end of the year, contingent on further deterioration in labor market conditions. Conclusion. Barry Knapp concludes by stressing the importance of a nuanced approach to economic and monetary policies to balance growth and stability. He calls for more thoughtful consideration of the interplays between different policy measures, cautioning against the potential repercussions of oversimplified solutions. Final thoughts. Barry encourages viewers to stay informed and critical of economic policies, advocating for a focus on sustainable, long-term economic health rather than short-term market reactions. Key takeaway: the importance of aligning fiscal and monetary policies to address structural economic challenges, with a particular emphasis on supporting small businesses and ensuring financial stability. Video title: Growth Scare Hits the U.S. Economy. Barry Knapp on Fed's Quadrilemma, Lehman, and Job Market. YouTube channel: Blockworks Macro. Interview synopsis and analysis. Title: Stocks will continue to crush bonds in 2024. Joseph Wang. Channel name: Blockworks Mac. Guest name: Joseph Wang. Overview: in this interview on Blockworks Macro, Joseph Wang delves into the economic dynamics for 2024, centering on the performance of stocks relative to bonds. Through meticulous analysis and unique perspectives, he examines the implications of fiscal policies, unemployment trends, and global market reactions. Core thesis: the central thesis of the interview is that equities will outperform bonds in 2024. Joseph Wang posits that persistent fiscal spending and complex labor market dynamics will propel stocks upward, despite potential geopolitical and economic uncertainties. Key points discussed by Joseph Wang. 1. Fiscal spending and dollar depreciation. Details and evidence. Wang emphasizes the significant impact of ongoing fiscal deficits, which, according to him, effectively depreciate the dollar. Examples, statistics. He mentions a fiscal deficit of about 6% of GDP, translating to approximately $1.5 trillion annually, likening it to printing dollars. Illustration. Depreciation of the dollar is expected to create tailwinds for financial assets. 2. Federal Reserve cut predictions. Details and evidence. Wang predicts that the Federal Reserve will cut rates more aggressively than their dot plot suggests. Quotes, references. He references the discrepancy between market reactions and the more hawkish dot plot, highlighting the market's disbelief in the Fed's signaling. Illustration. Job market trends showing rising unemployment rates may trigger more cuts, deviating from the one cut currently signaled. 3. Unemployment predictions. Details and evidence. Wang points out that the current unemployment rate stands at 4% and expects it to rise, contrary to the Fed's projection of it remaining stable. Context. He argues that continuous immigration and softening labor demand will push unemployment higher. Illustration. This dynamic could force the Fed to adopt a more dovish stance with significant cuts, despite their hawkish posture. Number 4. Impact of geopolitical risks and fiscal policies on markets. Details and evidence. Wang discusses potential geopolitical risks such as escalating tensions in Ukraine and their implications for financial markets. Examples. He contrasts the current geopolitical climate with past crises, where initial market indifference shifted dramatically upon broader realization of risks. Illustration. Such risks could lead to volatility, though fiscal policies may buffer against steep downturns. Predictions by Joseph Wang. 1. Multiple rate cuts by the Federal Reserve. Details. Predicts 3 cuts by the end of 2024 instead of the one suggested by the Fed. Implications. This could lead to more bullish market conditions in the shorter term, but create challenges for bond markets. 2. Rising long-term interest rates. Details. Projects that long-tenured yields could reach up to 5%, driven by ongoing fiscal deficits. Implications. Higher yields could pressure fixed income markets, but equities may remain robust. 3. Equity market outlook. Details. Suggests a potential S&P 500 target of 6,000, particularly under a pro-inflationary policy administration. Implications. This positions equities as a favorable asset class amidst broader economic policies. Conclusion. Joseph Wang concludes by emphasizing the robust fiscal stimulus and its market implications. He encourages viewers to consider the broader economic frameworks, stressing the importance of staying informed about fiscal policies and geopolitical landscapes. The key takeaway is the significant upper tail risk for financial assets driven by fiscal largesse and potential Fed rate cuts. Final thoughts. While uncertainties exist, Wang's analysis provides a compelling case for continued equity dominance over bonds in the near term. His insights underline the critical intersections of fiscal policy, labor market dynamics, and geopolitical risks in shaping market trajectories in 2024. In this interview, Blockworks Macro hosts Jim Bianco, who discusses the implications of recent federal monetary policies, specifically focusing on inflation and interest rates. Bianco provides in-depth insights and analysis regarding the Federal Reserve's decisions, the current economic landscape, and potential future developments. The core thesis of the interview is the inevitability of persistently higher inflation and interest rates. Jim Bianco argues that the economy is likely transitioning into an environment characterized by stable and somewhat elevated inflation rates of around 4%, coupled with interest rates hovering between 4 to 5%. This viewpoint is supported by thoughtful commentary and evidence relating to current economic data, Federal Reserve actions, and historical context. Key points discussed by Jim Bianco include: 1. Federal Reserve's hawkish stance. Bianco elaborates on the surprisingly hawkish outlook from the Federal Reserve, given recent economic data. He discusses the dot plot showing fewer rate cuts in 2024 than previously expected, emphasizing that we are likely 6 months away from the first rate cut given present economic conditions. 2. Economic data and market reaction. He discusses how lower than expected inflation data and the Fed's more hawkish commentary influenced market behavior, including a rise in the stock market and bond yields. Specific quotes from Fed Chair Jay Powell and analyses of the Fed's dot plot play a critical role in shaping his argument. 3. Inflation dynamics and key predictors. Bianco covers the current state of key inflation components such as energy prices, owner equivalent rent, and wages, arguing that high energy prices, sticky rental costs, and sustained wage growth are likely to keep inflation elevated. Examples and context around past inflation report patterns are used to illustrate this view. 4. Broad economic outlook. He shares insights on overall economic behavior, the impact of political events, and the hard versus soft data dichotomy, with a particular emphasis on how these factors shape current economic sentiment. Jim Bianco also makes several key predictions, such as 1. Continued elevated inflation. He predicts that inflation will remain in the 3 to 4% range, influenced by sticky components like rent and wages. This implies a higher long-term neutral rate around 3.5% or higher, challenging the Fed's traditional 2% inflation target. 2. Stable but high interest rates. Bianco anticipates that interest rates will stay around 4 to 5%, driven by persistent inflation, limiting the scope for significant rate cuts in the near term. In conclusion, Jim Bianco summarizes his insights by emphasizing that current economic policies and conditions are reshaping the landscape into one of stable yet higher inflation and interest rates. He encourages viewers to adapt to this new economic reality, emphasizing the importance of aligning expectations and investment strategies with this outlook. His final thoughts underscore the necessity of understanding and preparing for ongoing economic shifts, advocating for awareness and strategic financial planning. The key takeaway is to prepare for a prolonged period of higher inflation and stable interest rates, which will significantly influence market behaviors, investment strategies, and economic planning. The title of the video is Get Used to 4% Inflation and 4 to 5% Interest Rates, says Jim Bianco. The YouTube channel is Blockworks Macro. In the recent Kitco news interview, host Michelle McCory engages with Gareth Soloway, chief market strategist at verifiedinvesting.com, who delivers a comprehensive analysis on the U.S. Federal Reserve's monetary policy, economic outlook, and its implications for various markets, including gold and Bitcoin. Core thesis. The core thesis of the interview revolves around the anticipation of a dramatic market downturn upon the Federal Reserve's pivot. Soloway argues that the Fed's current trajectory and economic conditions suggest impending significant market corrections, bolstered by in-depth commentary and historical data. Key points discussed by Gareth Soloway. 1. Fed's stance and market implications. Soloway elaborates on the Fed's decision to keep the federal funds rate steady and the signaling of only one rate cut before the year's end. He highlights the uncertainty in Jerome Powell's statements and the challenges in landing a soft economic landing. Evidence and examples. Soloway points to historical precedent and current CPI data showing persistent inflation above the Fed's 2% target. 2. Stock market dynamics. Soloway discusses the continuous rise in stock markets, like the S&P 500 and NASDAQ, despite economic concerns. The wealth effect, where rising stock prices lead to increased consumer spending, complicating the Fed's inflation management. Significant quotes. The Fed seems like they don't want to really force the market down, but if they don't, inflation stays north of 3%. 3. Banking system concerns. Soloway covers signs of distress within the banking system, including big banks offloading bad debt, potential parallels with previous crises, specifically mortgage-backed securities. Context provided, analysis of regional banking ETF charts showing a bearish flag formation, indicative of potential further declines. Key predictions. 1. Stock market correction. Prediction. Soloway forecasts a significant market correction, potentially around 18% by year-end, and deeper corrections by mid-2025 if recessionary pressures escalate. Implications. Such a downturn could trigger broader economic repercussions and influence the Fed's monetary policy decisions. 2. Recession timeline. Prediction. Soloway anticipates a recession in early 2025, expecting consumer spending slowdowns and broader economic contractions. Implications. Fed interventions during this period could exacerbate market volatility. 3. Bitcoin and gold prospects. Prediction. Despite near-term volatility, Soloway sees Bitcoin reaching $100,000 for 2025, driven by the search for safe haven assets amidst economic uncertainty. Gold is projected to rise to $2,800 by mid-2025 due to continued inflationary pressures and fiscal instability. Implications. Both assets are expected to perform well as investors seek stability in tangible and digital commodities. Gareth Soloway concludes by summarizing the necessity for caution in current market conditions, advising viewers to consider the broader economic implications of fiscal policies and market dynamics. He emphasizes the importance of diversifying into assets like gold and Bitcoin, which are poised to benefit from prolonged economic challenges. Title of the video: When Fed Pivots, Markets to See Dramatic Drop, Here's Why and What's Next for Gold, Bitcoin. Soloway. The interview provides a detailed, informed perspective on the potential financial landscape shifts, urging viewers to stay vigilant and strategically positioned amidst evolving economic conditions. In this interview, Kitco News hosts Federal Reserve Chairman Jerome Powell, who discusses the recent decision of the Federal Reserve to maintain the target range for the federal funds rate, providing in-depth insights and analysis. The core thesis of the interview is the Federal Reserve's strategic approach to managing the U.S. economy in uncertain times. Powell argues that while the central bank acknowledges improvements in inflation, caution remains essential, supported by thoughtful commentary and evidence. Key points discussed by Powell include: federal funds rate decision. Powell elaborates on the decision to maintain the federal funds rate at 5.25% to 5.5%. Citing a balanced but uncertain economic outlook and emphasizing the need for sustained confidence in inflation targets before considering rate cuts. He uses specific examples of labor market trends and inflation data to illustrate their argument. Economic projections. He also discusses the projections for the federal funds rate over the coming years, highlighting significant quotes from the Federal Open Market Committee, FOMC participants, who foresee a gradual decrease to 4.1% at the end of 2025 and 3.1% at the end of 2026. These projections support the cautious stance of the committee. Inflation and labor market. Additionally, Powell covers the recent dynamics of inflation and labor market conditions, providing context about the temporary shocks affecting the economy and emphasizing the importance of waiting for more consistent data before making policy adjustments. Dual mandate and policy stance. Powell further details the dual mandate of the Federal Reserve, maximizing employment and stabilizing prices, using additional examples to highlight how policy decisions are tailored to meet these goals in an unpredictable economic climate. Jerome Powell also makes several key predictions, such as inflation trajectory. He forecasts that it will take longer than initially anticipated to gain the necessary confidence to begin loosening monetary policy, suggesting that rate cuts might be more likely in the subsequent year instead of the current year. Economic resilience. Powell predicts that the economy, while facing inflationary challenges, will demonstrate resilience, with strong labor market conditions persisting in the near term. In conclusion, Powell summarizes his insights by underlining the cautious yet responsive strategy of the Federal Reserve. He encourages viewers to remain vigilant and adaptable to economic data, emphasizing the importance of bringing inflation back to the 2% target sustainably to ensure long-term economic stability and mitigate potential pain for lower-income individuals most affected by high inflation. The interview highlights the delicate balance the Federal Reserve must maintain in its policy decisions to foster a stable economic environment and the need for ongoing evaluation of economic indicators to guide these decisions effectively. In this interview, David Lynn hosts Brien Lundin, who discusses the looming debt trap and the Federal Reserve's potential policy shifts, providing in-depth insights and analysis. The core thesis of the interview is that the U.S. and global economies are on an unsustainable path due to massive debt accumulation and will eventually force the Federal Reserve to return to zero interest rates. Brien Lundin argues that the inescapable debt trap will necessitate drastic actions by the Fed, supported by thoughtful commentary and evidence on monetary policies energy demands, and commodities markets. Key points discussed by Brien Lundin include 1. Debt trap and monetary policy. Lundin elaborates on how the current debt levels and the Federal Reserve's past actions have led to a situation where maintaining high interest rates is untenable. He uses historical trends and data to illustrate how the Federal Reserve might be compelled to slash interest rates back to near zero. 2. Rising energy demand and AI impact. Lundin discusses the skyrocketing energy requirements driven by AI data centers, highlighting how projections such as NVIDIA's new processors drastically exceed existing power supply capabilities. He quotes NVIDIA CEO Jensen Huang to underscore the urgency of the situation. 3. Investment opportunities in metals and mining. Additionally, Lundin covers the bullish outlook for metals like uranium and copper, driven by both traditional industrial demand and emerging requirements from the energy transition and data centers. He contextualizes this with examples of current market trends and potential future spikes. Brien Lundin also makes several key predictions, such as 1. Interest rates. Lundin predicts that the Federal Reserve will have to cut interest rates dramatically, potentially back to zero, to manage the debt load and avoid economic collapse. 2. Energy and metal markets. He forecasts a significant and sustained increase in demand for uranium and copper, spurred by both the electrification of energy systems and the computational power needs of AI. In conclusion, Brien Lundin summarizes his insights by stressing the critical nature of the impending economic challenges, encouraging viewers to understand the importance of tangible asset investments like metals. He emphasizes the need for awareness and preparedness in navigating these looming financial shifts. The title of the video, Inescapable Debt Trap, Fed Going Right Back to 0%. David Lin. Highlights. The interview starts with a discussion about the debt trap and energy demands, citing NVIDIA's new processors and their immense power consumption as a concern. Lundin explains the dual trends of rising energy demand and the inevitable return to low interest rates due to unsustainable debt levels. He emphasizes the significant role of metals like copper and uranium in meeting future demands, but notes the challenges in scaling up production. Lundin believes nuclear energy is critical to future power needs and discusses the practical challenges and delays in building new reactors. Both the energy grid and metal supplies are highlighted as crucial areas needing investment and expansion. Regarding metals investments, Lundin sees a strong future for uranium, driven by increasing necessity rather than simply market speculation. He is bullish on copper too, spurred by global electrification efforts and technological advancements. Lundin also reflects on gold's historical performance and its potential as a hedge against impending economic instability. He predicts that gold could see substantial gains akin to previous bull markets due to the inevitable easing of monetary policies and long-term currency devaluation. Lastly, Lundin highlights the unique aspects and value of the upcoming New Orleans Investment Conference, promising insights from top financial experts. This interview presents an insightful analysis of the current economic landscape, substantial energy requirements, and the opportunities within the metals and mining sectors, all while preparing for potential significant shifts in monetary policies. Interview summary: in-depth analysis with Lobo Tiggre on economic indicators and gold market. In a revealing episode on the David Lin YouTube channel, host David Lin sits down with Lobo Tiggre, the editor of Independent Speculator, to analyze the Federal Reserve's recent decision to keep interest rates unchanged. The discussion delves into the implications of this decision on various markets and assesses Tiggre's economic predictions. The core thesis of the interview is that despite the Fed's unchanged rates, there are significant economic shifts that may lead to what Tiggre describes as a hard landing. Tiggre argues that the current economic optimism, reflected in a surge in stock markets, may be misplaced, supported by thoughtful commentary and evidence that illuminate underlying economic weaknesses and potential future challenges. Key points discussed by Lobo Tiggre. 1. Market reactions and Fed decisions. Tiggre elaborates on how the unexpected decrease in the Consumer Price Index (CPI) led to a morning surge in the markets. However, he notes that the Federal Open Market Committee, FOMC, remained conservative with its dot plot projections, emphasizing that the optimism might be premature. He uses specific examples, such as the standard dot plot indicating only one rate cut by the end of the year, to illustrate potential market miscalculations. 2. Fed strategy and economic data. The discussion highlights Jerome Powell's remarks on FOMC members' ability to change their economic outlook at the last minute. Tiggre points out that today's CPI print likely factored into the Fed's dot plot, suggesting a more hawkish stance than perceived. He supports this with significant quotes from Powell. Inflation dynamics and market expectations. Tiggre covers inflation's persistent nature, examining the effects of base levels from the previous years and the likelihood of inflation remaining sticky above the Fed's target. He provides additional context regarding commodity prices and base effects, painting a picture of a challenging path ahead for achieving the Fed's long-term inflation goals. Copper and economic indicators. Additionally, Tiggre delves into recent trends in the copper market, stressing the metal's role as a bellwether for economic activity. He argues that copper's price volatility is more reflective of supply chain issues than a strong economic rebound, using examples of disruptions in major copper-producing countries to support his point. Additional key points. Price wars in big box stores. Tiggre argues that lowering prices in retail sectors indicates consumer weakness rather than strong economic health, providing a contrarian view against the optimistic headlines about price cuts in grocery items. Predictions by Lobo, Tiggre. 1. Persistent inflation. Tiggre predicts that inflation will remain a critical issue, potentially even rising again due to base effects and ongoing supply chain issues in commodities. 2. Hard landing ahead. He foresees a hard landing for the economy, with a high likelihood of recessionary pressures becoming undeniable, leading to market corrections in commodities prices, especially copper. Conclusion. Lobo Tiggre summarizes his insights by emphasizing the precarious balance the economy is navigating. With nuanced views on economic indicators and market responses, he encourages viewers to remain cautious and consider the broader economic context. His final thoughts call for a critical perspective on mainstream economic optimism, underscoring the importance of understanding underlying economic mechanisms. Tiggre also reiterates the potential bullish aspects for gold and silver markets, driven by macroeconomic trends rather than mere price movements of other industrial commodities like copper. Key takeaway. The central message revolves around the need to scrutinize economic data beyond surface-level headlines and understand the deeper implications of the Fed's monetary policy and global market trends. Title: Fed Keeps Rates Unchanged. Hard Landing Approaches Lobo Tiggre. YouTube channel, David Lin. In this interview, Oxbow Advisors hosts Ted Oakley, who discusses the current state of the stock market, providing in-depth insights and analysis. The core thesis of the interview is that investors should stay defensive with their investment strategies. Ted Oakley argues that the market's current state requires a cautious approach, supported by thoughtful commentary and evidence on market valuations and investment strategies. Key points discussed by Ted Oakley include: 1. Current market valuations. Oakley elaborates on the high valuations of major tech companies, noting that many have become overextended. He provides details and evidence by referencing companies like NVIDIA, which has outperformed many other stocks and has high price-earnings (PE) ratios. Oakley cautions that starting new investments in these companies at their current levels is challenging. 2. Investment criteria. Oakley discusses his firm's approach to evaluating investments, highlighting their screening process that focuses on low debt and earnings forecasts adjusted for inflation. He points out that few companies meet these criteria today, leading them to focus more on consumer staples and energy sectors. Notable quotes include Oakley's remarks on the difficulty of finding investment opportunities in today's market. 3. Long-term investments in tech. Oakley covers his firm's long-standing investments in companies like Microsoft, Apple, and Google. He emphasizes the importance of these tech giants, but notes that Google is the only one currently evaluated as a buy. He provides additional examples of stable investments in consumer staples like Kimberly-Clark, explaining their value in a potentially weakening economy. 4. AI and future technological trends. Oakley provides an informed perspective on the rise of AI, comparing it to the early days of the internet. He discusses the uncertainty of how AI will be utilized in the future, but agrees it will play a significant role. His commentary provides a balanced view, acknowledging the potential without overhyping immediate impacts. Ted Oakley also makes several key predictions, such as 1. Market adjustment. Oakley predicts a potential market adjustment due to high valuations and economic uncertainties. He implies that defensive investments in consumer staples and energy might provide stability during this period. 2. Adoption of AI. Oakley forecasts the significant integration of AI into various sectors, but emphasizes that its future applications might defy current expectations. In conclusion, Ted Oakley summarizes his insights by urging viewers to adopt a defensive investment strategy, particularly in stable sectors like consumer staples and energy. He emphasizes the importance of thoughtful investment choices in an overextended market, encouraging a focus on quality and long-term potential. The title of the video is Ted Oakley, Bloomberg Business, June 13, 2024. The YouTube channel is Oxbow Advisors. Interview summary. Are we in bubble territory? Jonathan Treussard. Hosted by The Julia LaRoche Show. Guest Jonathan Treussard, founder of Treussard Capital Management. Date recorded June 12, 2023. Main topic, current economic state and market conditions. In this insightful interview, Julia LaRoche hosts Jonathan Treussard to discuss the complexities of the current economic landscape. Jonathan provides a detailed analysis of whether we are in bubble territory, considering various economic indicators, market behaviors, and historical contexts. Thesis statement. Jonathan Treussard argues that while there are concerns about specific asset valuations, the broader economy does not exhibit the classic signs of a global bubble. He emphasizes the need for careful, scenario-based thinking in today's uncertain economic environment. Central message. Jonathan contends that a balanced perspective, considering geopolitical risks and financial market signals, is key to navigating the current economic landscape. Key points discussed. 1. Macro view of the economy. Jonathan highlights the inconsistency and volatility in macroeconomic data, such as fluctuating interest rates and job reports. He explains the concept of money illusion and critiques the excessive liquidity injected into the economy during COVID-19, comparing it to swallowing the whole bottle of liquidity. Uses historical examples and current trends to illustrate the state of high inflation and its impact on economic stability. 2. Market conditions and inflation. Discusses how the volatility in inflation data affects Fed decisions and market responses. Points out the volatility in high inflation regimes and how one data point does not dictate a trend. 3. State of the consumer and wealth inequality. Examines the bifurcation in consumer behavior driven by wealth inequality. Raises concerns about the economic resilience being concentrated in fewer households. 4. Impact of AI revolution. Talks about the widespread push for AI adoption and its potential volatility depending on economic conditions. 5. Geopolitical influences. Explores how geopolitical uncertainties, such as the potential for global markets to split, impact investments in companies like NVIDIA. Key predictions. 1. Geopolitical stability's impact on tech stocks. Jonathan predicts that the valuation of companies like NVIDIA relies heavily on the non-realization of geopolitical risks. Any escalation could negatively affect these valuations. 2. Economic slowdown's potential effect. Suggests that a major economic slowdown could be necessary for a significant drop in interest rates, which is essential for stabilizing parts of the economy, such as commercial real estate. Conclusion. Final thoughts. Jonathan Treussard underscores the importance of resilience and humility in financial decisions. He advocates for a balanced approach that does not rely heavily on predicting exact outcomes, but remains prepared for various scenarios. Call to action. Encourages viewers to focus on purposeful wealth management and avoid the conventional wealth management industry's pitfalls. Jonathan emphasizes the importance of understanding and structuring wealth to ensure it serves a meaningful purpose, rather than letting it define one's identity. Title of the video, Are We in Bubble Territory? Jonathan Treussard. YouTube channel, The Julia LaRoche Show. In a series of thought-provoking insights, our experts spotlight both the consensus and divergences in economic predictions. Axel Merk and Knapp highlight the Fed's challenges in navigating growth scares and policy adjustments. Wang emphasizes fiscal policies driving stock outperformance, while Bianco warns of sustained high inflation. Soloway and Lundin present potential market downturns and strategic asset shifts. Together, these viewpoints underline the need for vigilance and adaptability in approaching financial decisions amidst economic unpredictability. Thanks for watching Financial News and Review for Thursday, June 13th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see, drop a comment below. See you next time.